Sam Altman and OpenAI recently submitted a confidential S-1 to the SEC, formally beginning the process to take the company public. Lead underwriters like Goldman Sachs and Morgan Stanley are already pushing for a public valuation in the range of $850 billion to $1 trillion. But the filing reveals a massive contradiction. OpenAI is seeking a record-breaking market cap while simultaneously hemorrhaging cash. How can a company scaling its losses at this rate be positioned as the next great tech powerhouse? In Q1 2026, OpenAI's revenue hit $5.7 billion, a historically enviable growth curve. However, that growth carried a negative 122% operating margin. For every dollar made, they lose $1.22, burning $3.7 billion in one quarter. Internal forecasts suggest this isn't a short-term dip. The company expects cumulative losses to hit $44 billion by 2028 before ever turning a profit. Unlike traditional software firms, OpenAI's losses are scaling in direct lockstep with its user adoption. This financial strain is driven by compute, the physical energy and hardware required to generate every AI response. It requires ultra-expensive chips and massive, power-hungry data centers. In traditional software, once the code is written, adding a new user costs almost nothing. But with generative AI, inference costs scale linearly. Every query costs the company money. As ChatGPT reached over 900 million users, the cloud infrastructure bills required to serve those requests skyrocketed. The current model creates a fundamental tension. The product is built to punish the company financially for every new person who uses it. This spending sustains a strategic hierarchy between the token and the harness. A token is raw intelligence, sold by the meter. The harness is everything else: the file permissions, the custom tools, and the specific workflows engineering teams build around that intelligence to make it useful. OpenAI is subsidizing tokens at a loss to force companies to build their software harness inside the OpenAI ecosystem. High switching costs protect this massive investment. Once a company rebuilds its development workflow around an OpenAI harness, they cannot easily migrate to a competitor. Every billion lost serves a purpose. By pricing raw intelligence at a loss, OpenAI attempts to starve out rivals while weaving its software into the back end of the global enterprise. But the race isn't over. Despite the heavy spending, ChatGPT's weekly active user growth stalled around 905 million in the first quarter. OpenAI has struggled to convert that free user base into $20 a month subscribers, forcing the company to pivot toward cheaper ad-supported tiers. Meanwhile, their chief rival, Anthropic, has also filed for an IPO, but with a different focus, racing towards its first profitable quarter. Anthropic currently holds 54% of the enterprise coding market. OpenAI is trailing with just 21%. If OpenAI fails to capture the enterprise harness before its competitors, their multi-billion-dollar cash burn will have bought nothing but an unprofitable chatbot. On the trading floor, investors are preparing to bet on a $1 trillion valuation despite these numbers. The bull case assumes OpenAI will successfully capture the enterprise software layer. If that happens, these historic losses will be viewed as a necessary temporary bridge to market dominance. The bear case is simpler. If the price of intelligence continues to drop while compute costs stay high, the business model may never stabilize. This IPO represents a massive bet on market capture. It will reveal whether these losses are a bridge to enterprise dominance or the final expansion of a trillion-dollar bubble.